Welcome to the world of double entry accounting. Today, we will uncover the magic behind the balance of every financial transaction. Imagine every time you make a purchase, two things happen simultaneously in the financial books: one credit entry and one debit entry. That is the essence of double entry accounting. Double entry accounting rules. Let us dive into some core rules. Rule 1. When assets like cash increase, we debit them. When they decrease, we credit. Think of putting money into a piggy bank. That is a debit. Rule 2. Imagine taking a loan. Your liabilities increase, so we credit them. If you pay off part of that loan, we debit. Rule 3. Equity represents ownership. If the company's equity grows due to profits, we credit it. If it reduces, say, due to losses, we debit. Similarly, the owner's capital, revenues, withdrawals, and expenses have their dance of debits and credits. Remember, every transaction affects at least two accounts to keep everything balanced. Rule 4. Owner's capital increases over the credit and decreases over the debit. Their normal balance is credit. Rule 5. Revenue increases over the credit and falls over the debit. Their normal balance is credit. Rule 6. Owner's withdrawals increase over the debit and decrease over the credit. Their normal balance is debit. Rule 7. Expenses increase over the debit and fall over the credit. Their normal balance is debit. Journalizing and posting transactions. Now, how do we record transactions? First, we identify them from source documents like receipts. Then, we post them in the ledger, analyze them using our accounting equation, and make a journal entry detailing the transaction. Journal entry components. Journal entries have four crucial elements: the date, the affected account's titles, the amounts of debits and credits, and an explanation. Think of it as telling a mini story of each financial activity. T accounts versus balance column accounts. While T accounts are great for visualization, balance column ledger accounts are the go-to in the real world. They provide a detailed view of account activity. Analyzing transactions. Every financial transaction is like a puzzle. Double entry accounting helps diagnose and process transactions. Analysis of each transaction follows these four steps. Step 1. Identify the transaction and any source document. Step 2. Analyze the transaction using the accounting equation. Step 3. Record the transaction in the journal entry form, applying double entry accounting. Step 4. Post the entry. For simplicity, we use T accounts to represent ledger accounts. Example 1. Dubai company gets 30,000 UAE dirhams cash from Ali. We debit cash for 30,000 and credit Ali's capital for the same. Journal entry. Cash on the debit column for 30,000 and owner's capital on the credit column for 30,000. Example 2. Dubai company pays 2,500 UAE dirhams cash for supplies and cash on the Example 3. Dubai company pays 26,000 UAE dirhams cash for equipment. Journal entry. Equipment on the debit column for 26,000 and cash on the credit column for 26,000. Example 4. Dubai company purchases 7,100 UAE dirhams of supplies on credit from a supplier. Journal entry. Supplies on the debit column for 7,100 and accounts payable on the credit column for 7,100. Example 5. Dubai company provides consulting services and collects 4,200 UAE dirhams cash immediately. Journal entry. Cash on the debit column for 4,200 and consulting revenue on the credit column for 4,200. Trial balance. The trial balance is our checkpoint. It ensures our debits and credits are in harmony. If they are not, we have missed something. Steps to prepare a trial balance. 1. List each account title and its amount from the ledger in the trial balance. If an account has a zero balance, list it with a zero in the normal balance column or omit it entirely. 2. Compute the total of debit balances and the total of credit balances. 3. Verify, prove. Total debit balances equal total credit balances. Financial statements. From our balanced books, we can now draft the financial statements. The income statement. the owner's equity statement, the balance sheet, and the cash flow statement. These provide a comprehensive view of a company's financial health. The four financial statements and their purposes are: 1. Income statement describes a company's revenues and expenses and the resulting net income or loss over a period due to earnings activities. 2. Statement of owner's equity explains changes in equity from net income or loss and any owner investments and withdrawals over a period. 3. Balance sheet describes a company's financial position, types and amounts of assets, liabilities, and equity at a time. 4. Statement of cash flows. The statement of cash flows lists the cash inflows and outflows for the period. And that is the world of double entry accounting, a delicate balance of debits, credits, and meticulous record keeping. Happy balancing!